Let's get more on the Indian markets and how to approach them, given the balance of risks out there domestically and externally. Of course, Somnath Mukherjee is with us now, CIO and Senior Managing Partner at Ask Private Wealth. Somnath, welcome to the programme. First of all, can you explain why you're recommending what appears to be a rather defensive tilt to portfolios?
Morning, Shri, and thanks for having me. The reason is that India is probably in the last legs of what is called very widely in India the time correction in the market. We haven't had a significant movement up or down since September of last year. Primarily driven by a couple of factors. One, valuations had gotten stretched, are still a little bit stretched if I look at numbers today. And that has dovetailed with, coincided with a slowdown in earnings. After a good 4 or 5 years of really, breakneck earnings growth post-COVID, corporate India has seemingly taken a breather in the last 1 year, and earnings growth has slowed down and slowed down considerably. We ended the fiscal year 25 with market earnings growth anywhere between 6 and 7%. And hence, if you take the duo of stretched valuations and slowing earnings, it just makes sense to be a little cautious about fresh incremental commitments into the market. On the other hand, though, the trifecta that determines equity prices, so there's valuation, there's earnings growth, and there is liquidity. The last leg of the trifecta is in blazing green shape. System liquidity has turned into massive positive thanks to RBI action over the last 2 or 3 months, and capital market liquidity remains as strong as ever. And hence, it's also not a market where you could take a decisive underweight call and stay out, which is where we sort of coalesce to a view that it's better to be invested, but be a bit defensive in terms of how we invest our money in.
Hence, neutral equities, overweight domestic and large caps. Does it come down to, Somnath, a value opportunity? And if so, is that where the value is?
See, value is relative, and especially in the Indian context, India has traditionally, for close to 3 decades now, been a growth market. So searching for value in the traditional measures of value, as we know in the rest of the world, may not yield too much in the Indian context. But structural growth drivers of India are still very strong. Macro fundamentals are in amazing shape, whether it is the current account, inflation, or fiscal deficit. All three are in amazing shape. So the base for the new round of bullishness, if I may use that word, in prices is very well set. It just requires a pivot moment, and as we know from many years, pivot moments can never be predicted. But once that pivot moment comes, the market's structured very well, or the economy is structured very well from a macro fundamental perspective. It just needs the cycle to turn a little bit. And hence, the positioning is more around companies that can weather any short-term volatility a lot better than others that may be a lot more vulnerable to short-term shocks in the system.
Understood. Somnath, how are you approaching this at a sector level, and how are you approaching consumption retail part of the market, given the somewhat mixed signals governing urban and rural demand? Festival season is approaching, Independence Day tomorrow.
Right. So first of all, we are extremely positive on the financial space, especially banks and the larger non-banking financial companies. That's one space that we think is well positioned and could also represent some level of quote-unquote value, as you might put it. So that's one space that we're really positive on. As far as consumption is concerned, it's a bit of a fork right now. Rural consumption, so themes around rural consumption seem to be better positioned than themes around urban consumption. Urban consumption has been slowing down for the last 3 or 4 quarters, despite the fact that the tax cuts announced in the last budget have taken impact. We haven't yet seen sort of showing color in terms of actual numbers on urban consumption indicators, but rural consumption has remained strong. The monsoons, which is sort of a mild indicator of how things will shape up on the rural side, have been good, both in terms of overall quantum as well as in terms of spatial distribution of rains this year. That
Yes.
should be good news for rural consumption as well. Independence Day comes up tomorrow. Festive season rolls in soon after. So there is a lot of hope that there is a pivot moment in terms of the cycle on consumption turning. But I would be a lot more confident about the rural themes than the
All
urban
right.
themes as of.
Somnath, should we be unduly concerned about the event risk associated with the tariff story? 25th of August is when the US delegation is in town to start the sixth round of negotiations. 27th is when is the deadline for 25% additional tariffs on India. Is there going to be an element of buy the rumour, sell the fact on those stories? And
I would rather
how would you sum it up?
switch it the other way, which is that hope for the best but prepare for the worst. I don't think there was any base case that would have left India as the highest tariff country or a trading partner of the US if anyone was talking, say, 1 or 2 months ago. But here we are. India has the highest tariffs of all US trading partners or all major trading partners around the world. Hopefully this gets sorted out, and
Yes.
it would be very odd if India remained the highest tariff trading
Indeed.
partner of the US in another
Indeed.
2 or 3 months.
And Somnath, the way that this is manifesting is that FIIs have been selling out of India, although domestic investors appear to be more sanguine. Do you think we've seen the worst of the flight of foreign investors, or is there more to come?
I think foreign investors are taking the relative value call. Obviously, India is richer than rest of emerging markets, and Indian earnings growth have slowed down. So they're taking the relative value call, and they'll probably reverse that call once India's growth momentum comes back. But honestly, not such a big issue anymore. Domestic liquidity is very strong. Last month, we just had the data for last month numbers come in a couple of days ago. Mutual fund flows through SIPs, which is the single largest source of liquidity in the market, was at an all-time high. This was the third successive month when mutual fund SIPs touched all-time highs. And so was overall domestic mutual fund flows, which tripled on a month-on-month basis. So FII flows can be very easily absorbed, or outflows rather, can be very easily absorbed. There is a very strong domestic liquidity pool, and it's not just the flow, but also the base. If you look at total amount of cash being held by domestic equity mutual funds, that's at an above average level of 7.5%, 8% today. Usual long-term averages are in the 5.5% range.
Yes.
So there's a significant amount of liquidity in stock that is available for investors or Indian investors to invest in. So I'm not terribly concerned about FII outflows. But yes, the tariff question is something that needs to be dealt with. Hopefully in the next 2 or 3 months, something will give, and a political deal will be in place to take care of it.
Let's hope so. Let's hope so, absolutely, Somnath. So in that interim period, those sectors from IT services, pharma, automakers, textiles, some of which are currently, as it stands, exempt. And I'm choosing my words very carefully here because you and I know that the Trump administration does change the goalposts because everything seems to be so non-binding. How are you approaching those sectors that are potentially at the sharp end?
As of now, the sectors at the sharp end don't get reflected too much in the market, so not a variable at all. Look at what are the sharp-ended sectors, i.e. sectors that actually face the 50% tariffs today. it's gems and jewelry, it's textiles. Both of which don't have too much of weightage in the markets. Forget the indices, even in the broader markets, not a massive amount of weightage. So not such a big issue. The issue is really more second order derivative, which is both of these sectors are extremely employment intensive, textiles and gems and
Exactly.
jewelry.
Yes.
And if these tariffs remain at 50%, a very large part of these exports will become unviable from India. Now, at a corporate level, they will find ways and means. I mean, they will reshore, like China has very successfully done via Vietnam over the last 4 or 5 years. So I'm sure Indian companies have enough resourcefulness to do an encore for Indian products as well. But that does not immunize Indian workers. So there will be there could be rather significant job losses if these tariffs remain at 50%, with downstream impact in terms of both consumption as well as the amount of money that government has to probably put in as a backstop to provide some level of security for people who are losing their jobs.
And we are already seeing that second-order derivative play out with the IT services with enterprise demand falling off, right? And TCS having to react to that, and there's an element of AI displacement too. How concerning was that? And 12,000 jobs going at TCS.
I wouldn't jump too much at that as of yet. It is a structural, and this has got nothing to do with tariffs, honestly, because IT services are not under tariff ambit yet. This is to do with the overall impact of automation, artificial intelligence, large language programming, what have you, that's sweeping the tech world. It's something that's not keeping even the US tech job market unscathed. There is no reason why the Indian IT services will fly unscathed either. But companies will, pretty sure, take pivots, corrective action, new businesses, all of that will happen. Don't see a massive amount of impact yet. Remember, the headlines look bad. The largest Indian IT services company, for the first time ever, triggering a bout of job losses. But look at this in conjunction with the fact that India continues to be a very strong recipient of GCCs, or Global Capability Centers.
Yes.
Companies, overseas foreign companies that are setting up centers in India, very large centers, and setting up wholesale massive IT offshoring and high quality IT offshoring projects out of India. So the aggregate consumption, demand, and everything else, I wouldn't jump into too many conclusions, but structurally it's something that we need to be aware of, and long term we need to see how this impacts the broader economy.
Long term, do you like this nascent deep tech narrative that's associated with the GCCs? I was talking to my colleague JP about this, and a big Singapore developer is really making a big bet in that regard in the Indian market with developing GCC investments in India. AI is such a double-edged sword. So do you believe that the GCC narrative has momentum in the longer term, Somnath?
Oh, absolutely, there is. A lot of people have forgotten and probably don't know that the whole IT services ecosystem in India was sparked off by a Texas Instruments investment done in Bangalore way back in the late 80s, early 90s. And that sort of spawned a massive ecosystem today, which is worth a couple of $100 billion plus in IT services exports from India today. So absolutely, I am extremely confident that this whole trend of GCCs coming into India will continue. There is no other market that offers the breadth and depth of skills, availability of manpower, and English language, familiarity that any other country can offer. So India remains extremely attractive from that perspective. And there is a lot of domestic focus, including from the government, on the entire deep tech area as well. I expect the Indian domestic market on many of these areas to be a much bigger contributor in the investment ecosystem in the next few years.
Can I bring in the government capex programmes and spending to round off? And how much of a driver does that continue to be, Somnath, for infrastructure and defence? And can I ask you a cheeky question? Do you like the story behind JSW Cement, which is coming to market today?
I wouldn't be able to speak on specific stocks, but specifically on the question of on government capex. Government capex had a great run for 4 years post-COVID, CAGR of roughly 25-30%. I think that slowed down, and that will remain roughly around the nominal GDP growth this year, which is about 10-11%, maybe a little bit more. This government has established over the last 1 decade that they are extreme fiscal conservatives. They don't want to let go of that reputation at all, which means that spending will keep in line with tax revenues, and tax revenues are likely to remain in that 10-11% range. So would government capex. So while it has been one of the prime drivers, in fact, one of the 2 key pillars of growth in the last few years, we expect that aggregate capex level will be modest in that early teens sort of level. In terms of specifically defense is a high priority, hot button area across the globe. We are seeing extreme amounts of action, even in Europe, which has been sleeping on this for forever, I think, since the end of the Second World War. In India, it's obviously a very hot button area thanks to our overall neighborhood. But there is a significant amount of work happening. Fully expect some amount of reorientation of government spends towards defense in the next few quarters.
Somnath, it's always a pleasure talking to you. Thank you very much indeed for your insights, sir. Somnath Mukherjee there from Ask Private Wealth. We are back in 2 minutes.